So John, let's talk. We scale, we get to a good point here, and you've been active through COVID here, right? Like you've added 10, $20 million to the portfolio. It's been impressive. Deals are very hard to come by, especially in the space that you're playing in. And they're not just dropping, they're not just falling in your desk here. So talk about I know you've used the term creating deals, right? In this environment, when everyone is scrounging, how have you made things pencil? How have you created the opportunities for yourself and your investors?
Well, my background's in marketing and advertising. I spent 15 years in corporate America, helping to develop campaigns and ideas for various brands. And the way I look at the business is you have to develop a business plan first and foremost. And that's what I actually enjoyed about flipping, the parts I did enjoy, right? It's seeing what's there, figuring out what you can create, and then going and executing. And I think it's the same way with even buy and hold. Not quite as sexy, but to your point, it's not just take the rent roll, take the T12, throw them into a spreadsheet and see what the value is supposed to be. I think that's how a lot of people invest starting out. And many of your listeners, particularly those who buy in the 2 to 4 unit space, that's probably what you're doing, right? You're taking the current rent roll, maybe where you think rent should be. You're looking at the T12 or the income statement, and you're saying, okay, hey, based on, the income and where they're at, this property should be worth X. And the difference when you scale into larger commercial property is you have to factor in the upside potential or what you're going to create. It's almost like flipping, right? Because instead of strictly buying based on the current net operating income, we're going to take the current operations, look at our business plan, figure out, hey, if we flip this project and, improve the kitchens and the bathrooms and add these different amenities and these different other income line items, what would the property be worth then? That's the way we're viewing it. So that's the first step, is not to focus just on what exists, but focus on what you can create. And for me, it's taking a creative look at that. Again, it's easy to think about, well, hey, if we fix up the kitchens, we could rent this for X. That's the step many people take. The next step is to say, who are the real competitors? What other things could we do? What's going on with the other income line items? So that's everything from laundry income to think about technology. So that could be cable or internet packages. That could be, smart technology that you add into a unit. It could also be, pet fees and pet services. So I'm trying to look at all of those different factors based on the demographic of who the resident is, what's in the marketplace from a comparable standpoint, and determining what's the best business plan for that property. The other thing, and this is super key, is you cannot compete with hundreds of other investors because it's going to be very hard to find a good deal. So that doesn't necessarily mean you have to only go off market, but you have to change the way you look at it. And I think there's two ways you find a deal in this market. You either find a property that is being mismanaged, or you find a property that's being mismarketed. And mismarketed can mean that whether it's with the wrong broker, maybe it's with a residential broker and they don't get commercial, or it's a single family agent and she's never done a multi-unit property. So it's priced, wacky, or it's not even listed on the websites most investors would go to, or they don't see the real business plan or the real opportunity. And for us, that's really the key. It's sometimes people, they see what's there and they just try to do more of that, as opposed to saying, but actually, if you look at this, here's something else we could do that might be a pivot, or, maybe it's something you've seen another investor do, but it could create big windfalls for you. So it's just being creative really on what the business plan could be for that property.
All great stuff there, and couldn't agree with you more. I think the mismarketing is one that people overlook, right? Like there's a lot of, just because someone says it's X doesn't mean it is X, right? It could be Y. Like there's a reason. All the big guys must have passed. Not necessarily, right? It might not have passed their desk. People who are used to getting spoon fed, they're not really out there grinding and looking to find that arbitrage. So going back to that though, like what it could be, the potential. How do you balance? We get this question a lot. How do you balance what it is today? Like, here's the T12. Here's, I'm buying it at this cap rate, versus what it can be in 18 months. And you see that potential, But how much of that, like, where do you draw the line of what it could be versus what it could be today? Because there's some old school guys where this is what it is today. That's the price I'm paying, regardless of what the upside is. And on the other side of the spectrum, there's very speculative, like, yeah, but I'll buy it knowing that rents are going to go up, and like probably way too risky. And then there's a lot of people who fall somewhere in the middle there. And I think it's a very hard balancing act to value a property based on the current value and the future value. So can you share a little light, because you've done this, you've done it successfully. Like, how are you looking at that property? How do you balance that?
I think every investor has to approach this from their viewpoint. Our viewpoint is this: the deal has to make sense out of the gate. Yep. If the numbers don't work day one, then it just won't fly. Now, when we say don't work day one, what I mean is a positive cash flowing property. I don't necessarily mean give me a 10% cash on cash return day one. I just mean a property where there's enough income coming through to pay all the expenses, all the debt service, and still have some positive cash flow left over. So if we start there, then it's a matter of what's the upside and how much money can we actually make on the deal. Let's go back to flipping, right? If you think about flipping, there's zero income, right? You're going to take a property, do whatever it is you're going to do to it to make no money in the meantime, and then you're going to finish it. And then to make your money, you either have to rent it out and refinance and pull out your equity, or you're going to sell it. So when you're doing the deals we're doing, which is the syndication value add deals, it really is a combination of the two. So it's not fair or smart to only look at it with one lens. You really do have to blend the strategies if you want to find that opportunity. Because if you find a deal, I mean, think about flipping, right? If you try to buy a project that the best use is to flip it, but you try to buy it like a rental, and let's say, you can get $400 or $500 for renting it today. But if you were to take the time and actually fix it up and make it look nice, you could get $1,200, like you would need to take an analysis of, hey, what's the right business plan for this deal? So I come back to the business plan and the strategy. What's the story? Because that's going to weigh heavily on it. If you're telling me, hey, there's a property here where I'm not going to make that much money, but the overall area is improving and there's not much I can do to force appreciation, that's where I'm concerned. So the key here is, what can you control? Can you force appreciation through renovations or other means of adding value or increasing the NOI? Or are you simply hoping that the market continues to go up? I would be very concerned in an environment where you only have the market to help you, versus if there's a clear path for you to force appreciation and increase the NOI and increase the cash flow.